Hello, everybody. It's Max with Crypto Talk now. There's quite a few different cryptos out there in which don't have that many use cases. And if anything, they might not have any at all. For instance, there might be ones in which they have a great community, but they have especially no utility. Well, how about this for size? Quant, with hundreds of use cases. Without further ado, let's jump right into today's Quant coverage. So this actually, of course, is Gilbert Verdin again, and this particular video you're about to see, it's a short clip, about 2.5 minutes. And of course, shout out to Quant Papa who provided this. And like it shows, pure utility token, hundreds of use cases. And oh, by the way, like he mentions, the token is basically not needed, right? It's just, think about that in itself. Think about how many different ERC20 tokens out there, for instance, in which you basically do need the token. And if anything, when it's traded and so on, the big ass fees, you get what I'm saying. Top of that, real utility, like it says, max supply 14,000, I should say 14 million. I wish it was 14,000. 14,612,493. When does the FOMO come in? Well, in my humble opinion, quite a bit of FOMO, especially when this thing starts taking off and everybody starts talking about it, right? But without further ado, check out this particular short clip, 2 minutes and 20 seconds, with Gilbert Verdin in this particular interview, and then we will come right back here shortly for some more commentary.
So the QNT token minted in 2018 as a way to secure the network.
We're enforcing security. And so the Quant token is used to validate, verify, sign every transaction that goes through Overledger. From a security perspective, you need three things: confidentiality, integrity, and availability. Without that, security fails. And
so at its pure sense, we did everything to the core as making it as a utility token. And it's actually evolved, so it's a QNT.
And we're also using that as a means of value to transfer between different networks. So can you imagine a stable coin, a digital asset of some sort that can travel between Ethereum networks, Bitcoin, Hyperledger, Corda, and be able to be understood and transacted across different types of platforms? And we can do that with our technology.
I have lots and lots of meetings every week with governments, with enterprise, with institutions, with clients who want to build new technology and new what we call MDApps, so multi-DLT, distributed applications, on top of the network. So the QNT token is at the core of everything that we're doing.
Secret that we're working on, it's something to do with transport, and so we're using our features and the technology in Overledger to be able to transport digital assets across multiple blockchains.
And this will evolve. We want to make it the currency and the payment option for all the data and the transactions that are being put on the network.
The tokens are used for you to have access to the network, so you need licenses. And so when you have access, all those tokens are locked up. And then you pay transaction fees with the tokens as well. And so that's used for transactions. So it's kind of like Stellar, the way Stellar is operating, but then you're moving that digital asset with the token as well. So it's like a multi-utility token.
QNT, and it can be used for hundreds and hundreds of use cases around AI, data, if you want to do an MDApp on payments, if you want to do an MDApp as an exchange, anything, computes, if you want to create like an AWS equivalent on the Overledger network, all of this is possible. So QNT has just become that, pure utility token that can be used for everything. QNT token is at the core of everything that we're doing, hundreds and hundreds of use cases.
Great clip that was put together. And I really like the interview, for instance, with LCX. By the way, LCX, look more into them. We might do more of a deep dive for the likes of LCX as well. But let's get back to the subject at hand. Check this out as well. Here at CTN, we talk about, for instance, interoperability, right? Let's face it, when it comes to Quant, that's basically their slogan, right? So I love this particular diagram because it gives you a broader perspective. Real quick, for instance, in regards to like what it says right here. You must consider 5 ingredients of interoperability. Number 1, integrate with existing business systems, right? And what does that entail? Think about that for a moment. Integrate with existing business systems. Is that basically telling them, like we mentioned here before, you guys need to jump through a bunch of hoops to be interoperable with us? No. Integration in itself means just that, integrating, not forcing your standards upon other different systems. On top of that, initiate payments on existing rails or blockchain rails. And you can see how some of this is outlined. Number 3, interchain applications and smart contracts that can communicate across protocols. And you think about, for instance, not even with what is listed here, but some other diagrams that we had we provided, I should say, to those who especially watch us here at CTN. Those particular diagrams and like the APIs and so on and so forth, right? Number 4, interchain applications that benefit from value add of same underlying protocol, right? On the interchain. And then number 5, interchain applications to switch platforms, right? Think about that and what that basically entails. Now, one thing I do want to draw your attention to is, for instance, lower right area, right? Existing applications and services basically from what R3, R3's core to ecosystem, right? See where all that basically is. We covered, of course, a little bit of what R3 brings to the table. It's massive, and it's not just for the likes of Quant, but, for instance, what they bring to the table for, Ripple's XRP, you name it, right? So it gives you a broader perspective of how this all works. So I thought I'd go ahead and show you guys that. On top of that, sorry if I sound a little out of breath. I was kind of exercising before I made this particular video. So there's this as well, right? And if anything, check this out. I'm of course going to come back into the frame for just a moment. So look at this, and it states basically that's what a limited supply provides, scarcity. Now here at CTN we talk about, for instance, quite often, and I get it. Sometimes I get a lot of criticism. I get some Bitcoin maxis that come out of the woodwork and so on. And I'm not ever going to bash a Bitcoin maxi and so on, or anybody that's very passionate about their particular favorite crypto and so on. If anything, I think it's wonderful to see the debates. And if anything, come on, we live in a day and age in which we need to agree to disagree. I think that's something that needs to happen a lot more, if anything. So, to be honest, I actually welcome it. So, like it shows right here, that's what a limited supply provides: scarcity. No more than 21 million Bitcoin will ever exist. We made an image to show how this number relates to the world population. You may be thinking, well, I thought this is a quant video. We'll get to that. So I'm going to blow this up. And like you see right here, it says only 0.27 of the world population can own one each. Now think about this. When it comes to the likes of, for instance, quant, it would be even less than that, right? Because if anything, we have a lower circulating supply, lower total and max supply. And my key thing I want to point out, which we'll get a little bit more into this, is, think about how many people missed the boat, if you will, when it came to the likes of Bitcoin, right? My thing is also just that. I'm not going to miss out on the likes of Quant at all. More appealing circulating supply, total and max supply. And if anything, real world utility. People, of course, make the debate when it comes to Bitcoin. Well, it's a commodity, and it's basically like gold and so on. Is it really? Is it really when it comes to the whole subject of providing that real world utility? It doesn't really provide that real world utility, and I don't want to go down that rabbit hole again. But if anything, that's why I make the comparison. Quant is basically Bitcoin, but with real world utility, whether people want to agree or not when it comes to that. All right, a little bit more in regards to some of this. Again, back on that particular subject. So, as you can see here, it says with only 14,612,493 quant tokens created and already 14,544,190 in circulation, there's already 99% of tokens that have entered circulation. No more tokens are going to be emitted, thank God. No inflation. central to OVN ecosystem, and on top of that leads to large quant lockups. I'll blow this up a little bit more. Like it also mentions, with only 14.6 million tokens created and of course 14.5 in circulation, this means there are already 99% of tokens that have already entered circulation. There will also be no more, like it says, quant tokens minted. The token is central to the Overledger network ecosystem and will lead to large lockups by participants of the network. Kind of like what he just basically said, but worded a little bit differently. And that is just very, very attractive when you are looking at it from the point of view of when you compare and contrast this to the likes of Bitcoin, right? A little bit more on top of this, we talked about quite a few times here at CTN in regards to, what Quant brings to the table as far as asset tokenization, right? So, for instance, it says an HSBC report, and by the way, I always gotta give people a shout out who provide this information. A shout out, of course, to Lord Quantonian, who is at Big Bags with a Z 30K. But anyways, like it said, states, a HSBC reports on asset tokenization reaching, listen to this, 24 trillion by the year 2027. He states, I choose Quant as my play to have a part of this future. Hashtag quantified. Now, check this out. So, on this particular one, I guess I should probably come back into full screen a little bit more for you guys. Because, that could look a little bit tiny for you. So, give me a second. I think, you know what? I'm going to keep it right there. So, if anything, check out what it says. What is asset tokenization? So, for instance, here's some of these particular examples, like dematerialized physical assets today, for instance, which is stocks and bonds, real estate, sustainable assets, art, right? Physical assets. And then it gives you some examples, like about fractionalization, for instance, a third or original asset. But in regards to tokenization, it states specifically, assets are issued as tokens, programmable assets on the network based on smart contracts. And you've heard Gilbert Verdian, CEO of Quant, mention quite a few times that when it comes to Quant, it's not just about smart contracts, but it's about secured smart contracts. And if anything, I like some of these particular examples, but, let's just break it down a little bit more. What is, for instance, I wish I could zoom in a little bit more, but I can't. It says, what is asset tokenization? It says, for instance, the financial services industry is waking up to the transformative potential of DLT, right? Distributed ledger technology. It is estimated that in the United States, 1.7 billion per annum is currently spent on DLT in financial services globally. On top of that, the World Economic Forum estimates that up to 10% of global GDP will be stored and transacted via DLT by 2027. Tokenized markets could potentially be worth as much as, listen to this, 24 trillion by 2027, like we outlined above. For DLT's potential to be fully realized, financial market participants and infrastructure providers need to collaborate to galvanize change. And of course, it shows you some of this projected tokenized market volume until 2027. And it says US TRN by asset class. I know it's kind of a little bit hard to read on this particular one, but some of these different colors like listed equity, unlisted equity is also in orange. Again, it just kind of gives you a breakdown in that regard. On top of that, this, of course, comes straight from Quant. I'm going to get myself out of the frame for just a brief moment. You're going to hear this from Gilbert Verdian. It says basically financial institutions are adopting, of course, just that, digital assets. Hence why we're still on this particular subject. Sometimes worry about, for instance, the security of cross-chain bridges, and rightfully so, right? So, with traditional fiat, it's like, a lot of that money is being transferred. How do we hold companies, organizations, institutions accountable for what's going to happen with the new system that we're basically getting into? So it says, in this clip, Gilberti explains the approach we have taken to ensure the technology is ready for institutional use. And just remember this key thing, institutional use. We'll elaborate a little bit more in regards to that in closing. Now here's this particular clip, only about 1 minute and 42 seconds, and then we'll be right back.
And the issue is a lot of these are on-chain, which what it means is it's always accessible, so anyone can start probing and interacting with these cross-chain bridges and start finding vulnerabilities and holes. Whereas in traditional systems, in banking and capital markets, all of those applications and infrastructure are very well protected. They're under many layers of firewalls and other controls. And so they're very difficult to access for you to probe to find vulnerabilities. How you solve that, and we've taken that approach. We come from that background. We've been in this space for quite a while. We've created a hybrid approach where you are working with bridges, but those are not easily probable or accessible to third parties. You have to use a protected infrastructure of what we've developed to be able to interact with these bridges. So it's secure smart contracts. It's not just a smart contract on the chains. So we've solved that, and we set out to solve that early on. And our approach, we believe, is really a good mix of traditional security controls and decentralized technology in the right way, which is ready for institutions.
And with that said, think about what he said. Ready for institutions. We need to follow the institutional money, as far as I'm concerned. Let me come back into the frame just here in a moment. We're going to get right into just that. There's, of course, been the whole thing of the debate of, for instance, institutional versus retail investors, right? Institutional investors versus retail investors. Basically, what is the difference, like you see right here? And let's talk about it for just a brief moment. Because, if anything, it's not about just, introducing a particular coin or token to you guys and so on, and then leaving it just the hype or, some of these other things and so on. Here at CTN, we also like to provide education. So it states institutional investors, like I mentioned, versus retail. Now, here's a nice little breakdown, right? A lot of this I will read verbatim, but not all of it. So it says institutional versus retail. It's basically an overview. Investing attracts different kinds of investors for different reasons. And oh, by the way, this is from Investopedia. It is a pretty nice source. It says the two major types of investors, of course, are the institutional investor and the retail. An institutional investor is a company or organization with employees who invest on behalf of others. The manner in which an institutional investor allocates capital as to be invested depends on the goals of the companies or organizations it represents. Some widely known types of institutional investors include pension funds, banks, mutual funds, hedge funds, endowments, and of course insurance companies. On the other hand, retail investors are individuals who invest their own money, typically on their own behalf. Broadly speaking, the main difference between, of course, institutional investors and retail are at the rate of which each trades, the volume of the money, and of course, investments involved in their trades, the cost of each, what they pay basically to invest, so on and so forth, right? Of course, there's some key takeaways here, but what I want to jump down to, for instance, is this down here. It's way, way down here. But like it says, the key differences, right? Because that's the gist of what you want. So it says there are quite a few differences between institutional investors and, of course, retail investors, some of which have been pointed out previously. Below, you'll find a summary of the key differences. Now, here is just that. So on the left, institutional investor, in regards to funds, enormous amounts of pooled money. Apologize, I got some bad allergies today. It says enormous amounts of pooled money that belongs to the companies or organizations for which it invests. And then as far as retail investor, limited to the amount, of course, of that, just that, the individual and what they make and so on, right? But check this out also. Potential trading impact. Huge differences. Large positions and frequent transactions can result in sudden price movements that are unexpected by other investors and can move an entire market in unexpected directions. In regards to the retail, typically smaller trade sizes and less frequent trading has little adverse effect on market movement. Think of how many different cryptos there are out there, and which is basically just focused on what? The actions and reactions of retail money. Compare that to the likes of institutional money, and there are huge waves of differences, to say the least. As far as the emotions, right? Let's face it, when it comes to retail emotions of trading, it is huge. So look at this particular example. From the institutional side, it says less of an issue due to investment and market experience and expertise, education, and instant access to, of course, feedback and advice. On the right side, when it comes to retail, may occur due to lack of investment, education, obviously, and readily available market feedback, can have a positive or negative impact on markets if substantial trading occurs by enough individuals. And also think about this for a moment. What about the emotion of, for instance, not even doing their own research? They just see something that's trending, they don't know nothing about it, and they dump a bunch of money into it. Technically speaking, that's retail money. That's definitely not institutional trading. As far as transaction types and sizes, block trades of 10,000 shares or more. And of course, when it comes to retail, you're looking at about round lots of about 100 shares or more. There's a little bit more in regards to this, like we're talking about, for instance, the experience, education to what they know about, for instance, crypto, et cetera, et cetera. When it comes to institutional money, subject to less protective regulation due to investment expertise and knowledge. All right. How about this, for instance, where it says limits, not likely to limit buying to any particular size or company or share price level, of course, on institutional. And then as far as retail, more likely to invest in stocks or companies, or I should say of companies with smaller share prices to enable more purchases or diversification. Where does that basically happen? That happens basically when it comes to a lot of, let's face it, meme tokens, right? So for instance, you have this one puppy dog emu project and so on is 0.8, 10, 12, 16 zeros and a number, right? Perfect example. Last but not least, where it says information advantage, on the left side it says access to extensive market research and up to minute market insight and specialist feedback. Where on the other hand, from retail perspective, access to a wealth of information, has less access to the information reserved for institutional investors. Why? Think about this, the NDAs, right? The non-disclosure agreements, right? So there you go. What percentage of investors are institutional? This is one of the key things I want to show you basically with you guys. The entire number of actual active investors, both institutional and retail, is hard to know. However, it is known that institutional investors account for more than 85% of the volume trades on the New York Stock Exchange. Now, it's funny, the whole number when it comes to 85%. I did a recent XRP XLM / quant video, and it specifically mentions how by 2025, that all of 85% of all cross-border payments will basically be on ISO 222. And then this last part, what are the different types of institutional investors? Institutional investors can be pension funds, mutual funds, money managers, banks, insurance companies, investment banks, commercial trusts, endowment funds, hedge funds, private equity investors, and of course more. And there you pretty much have it for the most part. Wanted to share that with you guys because, if anything, it gives you a broader perspective of the difference between retail money and institutional, as far as like investor points of view. My key takeaway is this: in closing, I'm going to find, or I should say, I'm going to follow more of the institutional money, especially when it comes to my cryptos. Why? Because if anything, I want to follow the ones in which are involved with massive waves of money basically being transferred. And what stands out above all, the ISO coins, if you will, Quant, XRP, XLM, you name it, right? So I hope this gives you a broader perspective on things, especially like some of these, compare and contrast scenarios that we basically have, where whether it's basically comparing Bitcoin to Quant, etc., etc. Quant has just that, hundreds of use cases, and we'll continuously cover the likes of Quant as well as the other ISOs here at CTN for you. Thanks for watching today's video, everybody. Like, comment, and subscribe if you haven't done so already. Please hit that bell notification if you don't mind. And if anything, we'll see you on the next one.